Okay. Good morning, everybody. This is the live market open for February 15th, the day after Valentine's. I'm Yohay Elam of Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. Okay, and today on the show, as always, we'll cover recent developments in markets, go over charts and levels. We have technical segments, lines of support and resistance, discuss the upcoming events. Then our currency of the week this time is dollar CAD, with everything going on in oil. We'll have a special segment, the Trump report card. He's completing almost a month in office, and it's time to look at the impact on markets. And our normal segment, the week ahead, before wrapping up the show. Most importantly, your questions are more than welcome. If you cannot see the chat box alongside the screen, please go to the address here, tlk.io/fxstreet-forex-live-video. Okay, what's going on in markets? Well, the big thing in markets is Yelen's Valentine's testimony. It was yesterday. That was quite a big deal. Let's focus a bit on that. So we had Yellen talking about presenting her testimony when the headlines came out. It was analyzed. It was seen as more hawkish than expected. And indeed, it was quite upbeat on the economy. Yellen ignored the fact that last time wages actually dipped in the last non-farm payrolls report and saw wages in general, the bigger picture, as rising. Okay, labor market, also more jobs are being gained. Inflation is getting closer to target. And most importantly, when she talked directly about interest rates, Yellen said that interest rates are set to rise this year in one of the upcoming meetings. Okay, this was the key phrase, one of the upcoming meetings, but rates will rise. She talked about plural more than once this year, so at least twice. And one of the upcoming meetings, some thought that she opened the door for a March rate hike. So this testimony, at least it was analyzed as opening the door, even though I don't think they'll raise rates in March. I think they'll wait for more news from the Trump administration and wait for June. Then, if the economy is really strong, they could raise rates in June, September, and December, 3 times, like they said back in December 2016. But markets still think there are going to be 2 rate hikes. So this was what she said. Regarding Trump, they said, okay, she said fiscal policy can have an impact, of course, but they still don't know what's going to be. She would advise not going, totally off budget with crazy spending and doing some pro-growth policies, which is saying things that are very general. She dodged questions, of course, about fiscal stimulus. All in all, the dollar reacted positively, went up in the immediate aftermath across the board. Then it was some stage of consolidation, and then we've seen another round of US dollar buying. Of course, it was most evident against dollar yen. We'll see the charts later on. All in all, this was very hyped testimony because it was the first one in front of the new administration, and we had no press conference after the recent rate decision in February. So this time we got more action. Is the action justified? I'm not so sure, because Yellen tried not to rock the boat, repeating what she already said. We know they're going to raise rates in one of the upcoming meetings. I don't think March is on the table, but markets were looking for headlines, and I think we got them and we got the action. So when we have volatility in markets, we cannot complain. Okay, so that was Yellen's testimony. It had a significant impact. Yellen continues testifying today, but there is no new statement. Okay, she's going to repeat the same statement and going to be asked more questions. Now, there is a chance she will provide more headlines in her answers to the questions, but usually the first day of the testimony has more impact than the next ones. Okay, what else is going on in markets? Donald Trump, the president, is moving a bit more slowly in comparison to his first weeks. We'll talk about Trump more in detail later on. He's meeting with leaders. Today's meeting with the Prime Minister of Israel, Benjamin Netanyahu. He met with Justin Trudeau of Canada and Shinzo Abe over the weekend. His administration is embroiled in scandal. The National Security Advisor, Michael Flynn, had to quit, and there are still ramifications from Trump's campaign, Trump himself dealing with Russia before the elections, after the elections. This is all political. I think it's very important, but we're not seeing an effect on markets so far. Okay. Other things going on in markets, political events in Europe matter. We had a segment last week. You can watch it about euro dollar. We're seeing how opinion polls in France, Germany, the elections are far, and the Netherlands are having an impact on the euro, a negative impact. This continues also this week. Oil prices, another thing we'll focus on with the dollar CAD thing, is still, well, not moving that high. Okay, so OPEC released a report that its members are 90% compliance. Non-OPEC members, not so much, 50-60%. Most of the burden is on Saudi Arabia. On the other hand, U.S. shale production continues rising. There are varying reports about demand. On one hand, demand seems strong in Europe because of cold winter. Indeed, I'm living here in Barcelona. Winter was quite cold. On the other hand, India's consumption is a bit lower, so it's a mixed picture. We'll talk about oil more later on. Okay, let's discuss some of the data points that we had recently. So just the end of last week, U.S. consumer confidence missed with 95.7 points. Okay, that was just under expectations. Maybe it's related to Trump, maybe not. Okay, Japanese GDP missed with rising only 0.2, but at least it was a full year of growth in 2016. No quarter of slides. Chinese CPI was stronger than expected. I didn't write the numbers here, sorry, but it came out stronger than expected and was good for the Australian dollar, showing that higher demand means higher prices and probably higher demand for Australian goods. German GDP, also here I didn't fill it, sorry, it came out below expectations, 0.4 instead of 0.5, and it had an impact on the Eurozone GDP, which was downgraded to 0.4. So still better growth than beforehand, but not as strong as it used to be, weighing on the euro. UK inflation came out a bit under expectations at 1.8 on the core and 1.8 on the headline inflation. More of the Brexit effect. Again, Mark Carney at the Bank of England would like the pound to rise just a bit, so inflation would be a bit lower, but without having to raise rates and to curb demand. And US PPI came out a bit stronger than expected, but this is a warm-up to the more important event we have today, the CPI, the Consumer Price Index. Okay, see no questions. It's time to go to the charts. I see here something. Good morning, FX Ambassador. Yeah, 2 rate hikes, you say, September and December. I think, well, it might be June and December, but anyway, let's see, we'll know soon enough. Okay. Okay, so this is a technical segment. The major pairs, technical lines of support and resistance for the middle of February, second half of February. So we're beginning with euro dollar. Euro dollar is, of course, lower. Problems in Europe and some US dollar recovery thanks to Yellen. You can see clearly the move here that Yellen pushed euro dollar below 106, below 105.90, which now turns into resistance, a clear separator of ranges. Let's zoom out a bit. Well, to the top side, we have 106.20, which is not as strong as it used to be, 106.50, and 107.10, which is already a strong line. To the downside, we have 105.20, 104.60, both are old lines, and of course the ultimate line of support, which is 103.50, the 14-year low. Yeah, and we'll talk about the Aussie and the Kiwi soon. Pound dollar also, we're seeing the Yellen effect, seeing it falling back to lower range. 124.55 is the current level. Support here at 124.15, followed by 123 121.50. To the downside, further below, we have 122.50. And 122 and 120 is the ultimate line. To the top side, 125.40 remains resistance. It's followed by 127 round line, and then the initial post-Brexit low, 127.90. So pound dollar more or less in range in the past few days. We have quite a few more indicators to move the pound later on. Dollar yen, of course, the biggest mover from when we're talking about US dollar events. We're seeing dollar yen moving one range to the upside, breaking above 114. Next resistance, 114.75, followed by 115.40. Much further above, I see resistance only at 117.50. To the downside, under 114, we have 113, another round number, 112.50, 112, and then very strong line of support there at 111.40. Okay, let's move to commodity currencies. Dollar CAD, we'll have a special segment on the Canadian dollar. Remains relatively choppy, leaning lower but not breaking 130. So resistance here at 132.15, followed by 133 and 133.80. To the downside, we have, of course, 130 and 128.30. Aussie dollar, high range. We can see how it moved above this critical line here of 76.10, and currently it's relatively, well, a bit higher in the range, 76.73. At the moment, 77, the round number, works as resistance, followed closely by 77.40, and 78.40 is the ultimate line, the cycle high. In the middle of the range, we have 76.50 as a pivotal level, 76.10, very strong support, followed by 75.10, and down below 74.40. Aussie dollar became much more stable, trading in relatively narrow ranges, and then sticking to them before breaking to a new level. Kiwi dollar was hit last week by the Reserve Bank of New Zealand, currently 71.74, hit also by Yellen, but recovering from that. So currently, support here at 71.35, followed by 70.70 and 70. To the top side, we have 72.20, 72.65, and 73.50. Okay. Last and least, dollar Swiss making a move to the upside on this dollar strength. So we have we have resistance here, 100.80, followed by 102.30, very strong resistance. Remember, there are interventions here by the Swiss National Bank, support at 1, further support at just under 99, and followed by 98.60. Okay, so these are the levels to watch on dollar Swiss. This concludes our segment for major pairs for mid-February post-Valentine's. And now our technical segment about crosses for mid-February post-Valentine's. So we'll begin with the Swiss franc. Very frustrating pair here. Hope you're not trading it, especially after this and bump. Euro Swiss 106.54. This is where they intervene. 106.35 support, 106.80 resistance. This is the current range. The S&P would probably like to see the pair rising towards the 108 to 110 level. Okay. Next up is much more interesting pair, the Brexit pair, Euro Pound. 84.80 is the current level. Resistance just above there at 85, followed by 85.70, which provided support when the pair was trading higher. 86.35 next resistance, and 87.80 strong line to watch. To the downside, we have 84.65 and 84.40, and much lower we have support at 83.30. Euro yen, two major pairs, two major currencies, currently 121 resistance, 121.60, followed by 122.40, which is already stronger, and 123.30. To the downside, we have 120, a round number, and 119, the cycle low. Okay, so these are the levels to watch. And the dragon, pound yen. Always a fascinating pair, lots of pips to be lost and to be made. 142.70 at the moment, resistance there at 144.80. Quite a gap there. And to the downside, we have under 142.12, we have 140.50, okay, which was both support and resistance, followed by 139, okay. Relative stability in pound yen, but if we zoom out just a bit, you can see that things can get much wilder here. So it's perhaps the calm before the storm. And we'll add to the crosses, look at WTI crude oil prices, stable at higher levels, unable to break the first post-OPEC resistance line of 54.50. Above 54.50, we have 55.20, the cycle high, the highest in around 2 years. Below that, we have 52, which has its historic importance. And under the 50 level, we have 49.50 and 46.50. So very much in range at the moment between 52 and 54.50. Okay, so this concludes our segment for crosses. Any questions? Let's continue. So let's talk about the upcoming events for this week. After Yellen, we have more Yellen. So, but before that, we have just after the show, the UK jobs report. Watch out for wages, but also for jobless claims. Let's see if the resilient UK economy, post-Brexit is still looking good, or if it's showing any signs of cracking. So far, so good. Big top-tier US releases at 1:30 GMT. Retail sales, the US economy is all about consumption. Previous report was quite mediocre. That was the one for December. Now we get the first report for January with revisions, of course. It can be confusing. And slightly overshadowed, but still top tier, US inflation, the CPI numbers. Let's see if core inflation remains resilient around 2.2, 2.3%, if it continues moving higher or not, if it's only headline inflation. And let's see if the US dollar continues to strengthen, like FX ambassador says here on the chat. At 2:15 GMT, we have also industrial output from the United States. Trump talked about reviving manufacturing, but it's a very small segment of the US economy. Yellen speaks again in Washington in front of politicians. Remember, the first part is just rereading the statement from yesterday, so the real action will begin at around 3:30 GMT or something like that, because that's when she will be asked questions by the members. Okay. So tomorrow, also quite a busy day for those who are trading the Australian dollar. We have the Australian jobs report in the middle of the night. The previous reports were quite strong, not very impressive, but good enough. Let's see if the positive trend continues. Australia got some good news from China this week. ECB meeting minutes, they come very late, 4 weeks after the event, but they can reveal if there were differences. If Draghi was dovish unanimously with full support from the Germans or not. At 1:30 GMT, we have building permits, housing starts, the Philly Fed Manufacturing Index, and jobless claims, all from the United States of America. I must say that with this amount of releases, the numbers will probably offset each other. We can also, if we focus only on building permits and housing starts, to housing figures, in many cases, one of them beats expectations, the other misses. So it can be a bit complicated, but if all of these figures go in the same direction, perhaps jobless claims, which reached another 44-year low last week, if they continue falling, and building permits, housing, so everything goes positive, then we could have another boost for the dollar tomorrow. And for those trading the Kiwi, we have retail sales in New Zealand. Friday, relatively relaxed day. Thank God it's Friday, but it's going to be important for the UK. For the pound, retail sales 9:30. Quite volatile. December was disappointing. Now we get January numbers, and then the US CB leading index, third tier, number, but it could trigger some action because it's the last event of the week. So quite a busy week we already had with Yellen, and we'll probably have a bit more. Any questions? Okay, now our currency of the week, dollar CAD. Here's a picture of US President Donald Trump with the Prime Minister of Canada, Justin Trudeau. They met this week in the White House. So there's lots, it's an opportunity to talk about the relations between these two countries which share a very, very long border. What's going on in dollar CAD? First, just to look at the chart, I would say the pair is looking for a new direction. We had a move to the upside, then a move to the downside, but these are all very, very choppy moves. Let's begin with the Canadian economy. Oh, Canada. Well, the last two jobs reports have been really great. And that's good news that the Canadian economy is not totally dependent on oil prices. Okay, they are dependent, but not totally. The Canadian dollar is still impacted by oil. And a negative thing in the economy is that there are worries about the housing sector. The regional government of British Columbia decided to curb house prices in Vancouver, and Toronto prices are elevated, I think also in Montreal. And of course, there are worries if it's a risk to financial stability. But the biggest worry, political thing, is lots of uncertainty about relations with the United States, about NAFTA, about the policies of Donald Trump. So if Donald Trump wrecks NAFTA, it's bad for Canada. If he makes minor tweaks in accordance with Canada, it's of course good news. If he provides fiscal stimulus in the United States, it'll have an impact on Canada. If the US economy goes down, Canada goes with it. So there's a huge, huge dependency on the United States. But let's talk about oil, because oil sometimes is the only driver of the Canadian dollar, even though it's not the only driver of the Canadian economy. It's assessment time for the OPEC Accord, okay? We had some data. OPEC members showed 90% compliance. Now, this compliance is Saudi Arabia doing more than it promised to do, and some other countries doing a bit less. But in general, this organization based in Vienna is doing its stuff. 90% compliance is much higher than 60% seen in the past. Other countries, such as Russia, are moving much slower, but they're also cutting production. Good news is higher demand from Europe's cold winter, but weaker demand from India. There have been economic problems there with the demonetization of the 500 and 1,000 rupee notes. So that hurts a bit the economy there. Both organizations, the EIA and IEA, are cautiously optimistic that oil has rebounded, demand is a bit higher, and supply is lower, and this could stabilize things looking forward. We have to see, of course, further compliance during the 6-month accord. Remember, this agreement lasts until June, and we'll have to see around April if they'll decide to extend it, if to continue with lower amounts of production also in the second half of the year. If they don't reach an agreement, of course, it could limit oil prices. So these are the things to watch out for regarding oil, and this has an impact on the loonie. Another thing we're talking about the Canadian dollar is the Keystone Pipeline. So here are maps. Basically, it's a huge pipeline, the Keystone XL, the extra large line that was rejected by Obama after an extremely long process and now approved by Trump via an executive order. So this pipeline is meant to send oil from the Alberta tar sands in Canada all the way to the Gulf of Mexico to Texas for exports, okay? It was rejected, So it's good for Canadian oil exports, bad for the environment. That's why it was rejected by Obama. The big question, does it make economic sense, okay? Does it make sense that the oil extracted from Alberta is quite expensive to extract? and sending it all the way, these thousands of kilometers, thousands of miles to Texas is also not that cheap. Of course, when oil prices are high and demand is high all over the world, it's good for Canada. Remember, it's not that good for the whole economy, only, but it does have an impact on the US, on the Canadian dollar. So with current oil prices, I'm not sure this project will go through, even if it has all the approvals to be built and hurt the environment. Okay, well, watch out for any news on the Keystone XL. US demand, huge and long border between both countries on the 49th parallel and elsewhere. Canada depends heavily on the US, but there's also another dependency on the other side. 35 US states have Canada as their #1 export destination. Okay, of course, states closer to the border, Michigan with the Detroit's car industry. But of course, the US is much larger, 10 times the population, more or less. Trump wants to change NAFTA. In the agreement, in the meeting with Trudeau, both leaders agreed to make some tweaks. Of course, this is an agreement signed in the early 90s, so of course it needs some upgrading. We're in the internet era. There's a question if Canada will get a side deal with the United States that'll work against Mexico. Prime Minister Trudeau has not been talking too much about that. What we learned so far from the Trump-Trudeau meeting, things we do know, is that the meeting was cordial, the meeting was okay, nothing big came out of it, no scandals, but we don't have too much data. There weren't too many leaks about what happened in the room, very different from what we heard from the, conversation Trump had with the Australian Prime Minister, for example, or other leaders. But all in all, at least this meeting shows that these two countries do not want to rock the boat too much. Trump does want to rock the boat with Mexico. What's going on in the US? Of course, we'll talk a bit more about Trump. We'll have a somewhat calmer Donald, embroiled in scandal and moving a bit more slowly. On Monday, he didn't tweet even once. It's a work week. He had a conciliatory tone towards China, so less trade wars, so that was positive, but still nothing about fiscal stimulus. We'll talk about that more in detail. So these are the 4 factors that the dollar CAD depends on. First of all, the US dollar is dominant, of course, all over the world. We've seen how Yellen yesterday, by talking up, by being upbeat about the US economy, boosted the US dollar, and that, of course, moved dollar CAD more than anything else. Second thing to watch out for, the relations of Canada with the United States. It seems that the meeting between the leaders put relations off to a good start, at least for now. Oil prices, of course, they're still important, but I rank them #3. They're relatively stable, and there are other things going on. And of course, #4, the Canadian economy, which looks, it seems that, more than 2 years after oil prices collapsed, there are other things moving the economy. So remember, Canada, big country, not only based on oil. Called a commodity currency, but perhaps it's a bit exaggerated. And now let's look at the dollar CAD chart. So dollar CAD, let's take a wider view of the pair. Let's look at the daily chart. Of course, we had in early 2016 this rise up to the top when oil prices totally collapsed. The Chinese stock market collapsed, reached 147. Since then, we fell all the way to under 125, and then a move to the top side. But as if we zoom in a bit, we can see that here we topped out at 136, sort of a double top, and then we had a move to the downside. But this currency pair is very, very choppy. Levels to watch here, 130. And then we have a big gap all the way to 128.30. In case the pair collapses, 127.70 and 126.30 are lines to watch. To the top side, 130.80, small resistance, 132.15, 133, 133.80. And then we have this old line here, which was very strong at some point, 134.60. 135, and of course 136. Okay. My personal tendency is to see a bit more upside here. I don't think oil prices will rise too much. I don't think Trump will boost the US economy as markets expect, and this can hurt the Canadian dollar. So all factors, I think, lead to a slightly weaker Canadian dollar. But again, moves are not that huge so far. Well, that doesn't mean they won't be huge later on. Okay. It's yeah. Okay, so our next segment is the Trump report card. Donald Trump, now president almost for 4 weeks. A lot has happened. I cannot cover everything, of course. I don't think anybody can cover it in a few minutes. But let's talk about the impact on markets. I think most of you are familiar with the news. Everything that Trump does dominates the news. New US president, of course, big country. And we'll focus, of course, on markets. So we had an erratic start to his presidency on January 20th. Lots of confusion. Something that Steve Bannon, here in the picture on the top, former editor of Breitbart, an extreme white supremacist, is actually running the government. I don't think so. I think many people have an impact. We have a calmer continuation, at least this week and also last week. Things are moving a bit slower. Less executive orders. Here is a nice sort of meme of Trump showing his executive orders. And what changed this week is that Steve Mnuchin, not sure how to pronounce his name, he has been confirmed as Treasury Secretary. So we do have the number one person regarding the economy finally in charge. So maybe we'll get a clearer picture. Okay. Trump and the markets. What markets want from Trump and what the logic is based on. Basically, after the elections, they believed everything he said about fiscal stimulus. Fiscal stimulus means lower taxes and infrastructure spending, deficit spending. So with fiscal stimulus, you have a stronger economy, higher stocks, higher inflation, higher interest rates, and a strong dollar. All this hasn't happened yet, but we had higher stocks and a strong dollar. So markets reacted. And markets believe that trade will continue flowing, perhaps with minor cosmetic changes, nothing too crazy. Okay. What happened so far? No fiscal stimulus plan has been shown. This was evident already in the press conference that he held before entering office, a few days before January 20th. He had this executive order to build the wall, so it's bad for relations with Mexico. So we had some of the trade issues that markets did not want to see. The meeting with Enrique Peña Nieto, the Mexican president, was canceled. The Muslim ban on 7 countries for their citizens to enter the United States, it backfired. It was rejected by the courts, and it caused a lot of political trouble. The Obamacare repeal and replace. So he signed an executive order about repealing Obamacare, but then nothing is happening. It'll probably maybe happen next year or something like that. Now it's sort of on the back burner. And the talk of deregulation, of dismantling Dodd-Frank or other things, this is certainly helping financial stocks. So we haven't seen real action yet, but markets are certainly moving. All in all, Trump's report card, I would say not so good. I mean, for markets, there are still worries about fiscal stimulus, worries about trade, some hope on deregulation. So maybe on that front, he can do more. And it hasn't worked too much. We have seen the dollar slide. Well, we have seen, at least this week. First of all, we've seen some calmer Trump. That means less weighing less on the dollar, allowing for the natural correction to happen of the dollar sell-off from the beginning of the year. And of course, Yellen, the Federal Reserve, took the baton back in pushing the dollar higher. So at least temporarily, we're seeing monetary policy having more impact than politics. I don't think, which is what we've seen in the past few years, but politics had a stronger role in the past few months. I don't think it'll last too long. I think politics will make a difference once again. So what's next for the US dollar? The Donald and the dollar. If we'll have more of the same, too many political scandals, no fiscal stimulus, well, we can have a disappointment, which I think we're already beginning to see a disappointment from Trump by markets. But, well, stock markets are still looking good. So we'll have a bigger fall in stock markets and the dollar before we reach 100 days, before the end of April, and an extension of the dollar reversal. If we'll have a calmer Trump, but no fiscal stimulus, we can have range trading as we wait. And if we have finally a fiscal stimulus plan from the new Treasury Secretary, Steve Mnuchin, we could see perhaps the US dollar re-strengthen once again after the correction, also boosted, of course, by Janet Yellen, which we've seen this week, and it can move higher. So these are the three scenarios: more political trouble and trade wars and nothing going on. We could see a dollar sell-off. We could see stability if we have just a normal week in the White House, which is hard to find, and if we have what markets hoped for, a fiscal stimulus plan, a stronger US dollar. Okay. Hi, sorry about that. I understand there was no sound. Let's begin this segment. I hope you can hear me now. Let's begin the segment from the beginning. Okay, now. Okay, this is the preview for the week of February 20th to February 24th. After we had a very busy week, next week will be a bit calmer. That leaves more room for politics to have an impact. On Monday, there's nothing much on the agenda, so maybe we'll have some weekend news having the impact. On Tuesday, the RBA meeting minutes will provide us some insight about the recent decision in Australia. That didn't rock the boat too much, but maybe the minutes will reveal a bit more. Flash PMIs from the Eurozone for February will be on Tuesday morning. Mark Carney will appear once again in public, this time talking about the inflation report. He has recently made quite a few public appearances, so it might not have such a big impact, but you never know with the pound, which is very, very volatile. And for those trading the Kiwi, we have the bi-weekly milk auction. Milk prices, dairy prices have been on the rise lately. Wednesday is a busy day with the German IFO business climate, which fell last time and disappointed after the weaker than expected German GDP. Perhaps it'll fall a bit more. In the UK, GDP has been very resilient, 0.6 quarter over quarter, according to the first release. Will probably be confirmed. Well, again, we'll hear Brexit kind of headlines. oil inventories like almost every Wednesday, and the big event is the Fed meeting minutes. Once again, 3 weeks after the Fed decision, in theory it's a bit stale, but it's important to remember that the data is redacted, is edited until the very last moment. They know that this document is not only what happened in the previous meeting, but also what it means for markets. So this could certainly have an impact next week. Thursday, we have relatively empty day. Usually Thursday is one of the busiest days of the week. We have only the capital expenditure from Australia. It's a quarterly report, and the RBA looks very closely at it. So for those trading the Australian dollar, maybe this will be what moves the Aussie out of range. And on Friday, we do have quite a few figures, not quite Friday like this one. So we have the German and Spanish CPI reports for the month of February. So these are flash reports. Let's see if inflation continues pushing higher, and also inflation in Canada. And last but not least, US new home sales. There's a good correlation between sales of new homes and the economy at large. Okay, so relatively quiet week in terms of, in comparison to this week, in comparison to the next one, but there's always politics to move markets. Okay. Any questions? So this is the wrap up for the post-Valentine's edition of the morning show, February 15th. We had quite a few events in markets. Yelen's Valentine's testimony had a strong impact. She was upbeat about the economy, talked about raising rates in one of the upcoming decisions. The chances for March are slightly higher, but I think we'll have the first rate hike coming in June. In any case, the dollar moved higher, significant move. She continues speaking today. Trump is somewhat calmer, at least on trade, embroiled in scandals and meeting with leaders. So the politics, in terms of market moving events, politics moved a bit aside in the United States, not so in Europe, where every opinion poll in France, Germany, and the Netherlands does have an impact on the euro, and it's negative. The biggest risk is France. Watch the previous show for the segment about euro dollar. Oil prices begin moving up. The OPEC Accord so far is successful, 90% compliance, but other countries are moving a bit slower. And thanks for the kind words. In terms of data, well, we had miss on German GDP and on Eurozone GDP. This could have more of an impact. Let's look at the charts in this wrap-up, beginning with euro dollar. We're seeing it continuing to the downside this morning, moving below this line here of support at 105.90. Next level of support, 105.20. So an extension of the US dollar strength this morning. Further support, 104.60. Resistance, 106.20, 106.50. Pound dollar, a bit more stable, waiting for the jobs report coming up soon. Support 124.15, 123.50, resistance 125.40, 126. Dollar yen 114.50. It's clear to see the Yellen effect here. 114. Where's that line? 114.75, 115.40 are the next levels. 114, the round number, is a separator of ranges. Support there at 113. All right. Dollar CAD, we had a special segment on that. 130.75, 132.15, 130, and 120.30 are lines to watch. Aussie dollar, very much in range. The range is 76.10 to 77. Let's see if we have a breakout out of this very clear, well-defined range. And the Kiwi dollar recovering from the RBNZ, currently 71.72, resistance 72.20, 71.35. Let's run quickly on a few key events to watch out for this week in the wrap-up. So we soon have the jobs report in the United Kingdom. Retail sales, all important, top tier figure in the United States. And together with inflation data, it could be explosive. Yellen speaks once again. No new statement, but watch out for questions and her answers. Tomorrow, Australian jobs report. Lots of US data, but it could be contradicting. Just too much information at the same time. And a relatively quiet Friday before next week's key event, which is the FOMC meeting minutes. Before we head off, I see here comment, oil manipulation will continue and produce range trade. Yeah, so far oil is relatively stable, I must say. But well, again, a few factors here. Ongoing compliance and more reports about supply and demand, inventories. For the next big move, we'll have to wait towards April, when, assuming this agreement works out as expected, we'll have to see if the agreement continues on. I think there is a bit more of an upside potential to oil prices, but not that much. Eventually, the pendulum swing, which is the US shale industry. So if we have less production from Saudi Arabia, again, they're doing more than they were supposed to do, okay? Sort of excelling, the best in class. But for each barrel that Saudi Arabia cuts, the US shale industry can also produce another barrel. Oh, it's not exactly like that, not one for one, but we're seeing how flexible the US shale industry is. So again, but also watch out for demand. In theory, demand, well, cold winter is rising, but yeah. Anyway, thank you everybody for the show. Thank you for coming, for the questions, and wish everybody a safe and successful day in markets. Big events coming up, and see you. Thank you, and bye-bye.